U.S. Bancorp just beat Q2 2026 consensus estimates across the board, posting a record net revenue of $7.71 billion and delivering a diluted earnings per share of $1.35. I mean, that is a massive 22% year-over-year increase on the bottom line. And right after those numbers dropped, CEO Gunjan Kedia issued forward guidance saying the bank is entering the second half of the year with, quote, a favorable economic backdrop and strong momentum.
Right, and the market loved it.
Oh yeah, shares were rallying hard in early trading.
Well, if you're an investor looking at the banking sector right now, our mission for this deep dive is to really synthesize this massive stack of sources we've gathered. So we're looking at the Q2 earnings release, the internal segment breakdowns, and of course that forward guidance from the CEO. We need to unpack exactly how they engineered a 20% year-over-year jump in net income, which, takes them to $2.17 billion.
Yeah, $2.17 billion is huge.
It really is. So we're going to examine the diverging performance across their segments, look at the mechanics of the margin expansions, and evaluate these strategic acquisitions they're using to just fundamentally reshape the business model.
Okay, let's unpack this. We've seen the record top line, but, a high top line doesn't actually mean much if the underlying mechanics are broken.
Exactly.
So to figure out if this kind of profitability is sustainable, we really have to start by looking at operational efficiency. And the data shows the bank achieved a massive 400 basis points of positive operating leverage compared to the prior year quarter.
Which is just a wild number.
Right. And to translate that out of banking jargon for a second, positive operating leverage basically means your revenue is growing way faster than your expenses.
Yeah.
It's like, imagine doubling the sales at a retail store without having to, hire a single extra cashier or pay more for electricity. Yeah. That is operating leverage in action.
Yeah, that is the perfect way to visualize it. And honestly, in the current macroeconomic environment, achieving 400 basis points is a major, major signal of structural health.
Because expenses are usually so sticky, right?
Oh, incredibly sticky. Most financial institutions today are battling just huge non-interest expenses. I mean, compensation costs are high, professional services are expensive, and then you have enterprise tech upgrades, which are just a constant drain on capital. So generating that level of positive leverage, it indicates a highly disciplined management team.
Right. They aren't just throwing money at growth.
Exactly. They are expanding their revenue footprint without letting operational bloat scale up at the same time.
And you can really see that discipline filtering down into the broader margin metrics too. Like their net interest margin, NIM, expanded to 2.79%, which is up 13 basis points year over year.
Yep.
And their efficiency ratio improved, dropping down to 57.1%. And for anyone tracking bank performance, a lower efficiency ratio is the goal.
Yeah, lower is definitely better there.
Right, because it means it costs the bank fewer cents in overhead to generate every single dollar of revenue. But if you want to find the real engine driving these margins, you've got to look at the divergence in the balance sheet.
That balance sheet split is so interesting.
It really is. Average total deposits only grew by 2.4%, hitting $515.1 billion. But average total loans grew at a much, much faster pace of 7.1% year over year, and that reached $405.5 billion.
Right, and that gap right there, that gap between 2.4% deposit growth and 7.1% loan growth, that is where the real money is being made.
How so?
Well, when a bank's loan portfolio expands at, triple the rate of its deposit base, management is aggressively putting idle capital to work.
Ah, I see.
Yeah, they are pushing their loan-to-deposit ratio higher. And assuming those loans don't default, a higher ratio fundamentally drives higher interest income just because you're lending out a larger percentage of the cash you're actually holding.
So let me push back on that slightly, because I think a lot of retail investors look at banks right now and they just assume the success is purely macro-driven.
Sure, yeah.
Like, is the bank just getting lucky with the broader interest rate environment, or are we looking at real fundamental execution? Basically, is this just the tide lifting all boats? Or did U.S. Bancorp actually build a better boat?
What's fascinating here is that the data actually points to a fundamentally better boat.
Really?
Yeah. I mean, it is absolutely true that they're benefiting from the macro environment through this mechanism called fixed asset repricing.
Right.
So simply put, banks have older, cheaper loans on their books that are constantly expiring or being paid off. And in today's environment, when those old loans roll off, the bank reissues that capital as new loans at much higher current interest rates.
Oh, right, which naturally cads the margin.
Exactly. But that passive repricing, it doesn't explain a 7.1% absolute growth in loan volume.
Wait, so they aren't just sitting on their hands, waiting for old debt to become new, more expensive debt.
No, not at all. They are actively taking market share. That 7.1% growth represents genuine expansion of their loan book through new client acquisition and expanded corporate borrowing.
Wow. Okay.
Yeah, that core growth is the actual underlying mechanism that drove their taxable equivalent net interest income up by 7.5% to 4.38 billion. So they are expanding the actual volume of their business, not just riding the yield curve.
Okay, so if we accept that the overall margins are strong and the loan engine is actively expanding, we need to transition to where that money is actually being generated.
Yeah, we have to look under the hood.
Because when you look at the business units in this earnings report, things start pulling in very different directions.
Yeah.
If you want to understand the modern U.S. Bancorp, you have to examine the growing rift between their institutional clients and their everyday consumer clients.
Yeah, that internal divergence is perhaps the most critical takeaway from these sources. The top-line numbers paint this picture of universal success, but the segment data reveals a much more nuanced economic reality.
Right. Let's start with the absolute powerhouse. The wealth, corporate, commercial, and institutional banking segment is just roaring.
Unbelievable numbers there.
Yeah, they generated $1.53 billion in net income for the quarter. I mean, that is a staggering 30.3% year-over-year increase.
Huge.
But then you pivot to consumer and business banking, and the story flips. Their net income actually slipped by 4.4%, dropping down to $589 million.
It's not just there.
No, it gets even softer in the payment services segment, which dropped 4.3% to $225 million.
We do need to interject some structural context into those segment numbers, though, because management didn't keep the reporting boundaries entirely static this quarter.
Oh, right. They moved some things around.
Yeah, they actively shuffled the deck. The Impact Finance business unit was moved into the wealth, corporate, commercial, and institutional banking segment.
Okay.
And at the same time, they took the revenue generated by debit cards, which historically lived over in payment services, and they shifted it into the consumer and business banking segment.
That is an interesting way to reorganize the internal accounting. It's almost as if they're trying to consolidate all the large-scale capital functions into one bucket and then all the everyday transactional functions into another.
Yeah, that's exactly what it looks like.
But even if you factor in those accounting shifts, the divergence between corporate health and consumer softness remains completely stark.
Oh, the contrast is undeniable. And if you connect the performance of these segments to the broader economy, it offers a real-time pulse check on different tiers of the American financial system.
How so?
Well, a 30% jump in institutional and corporate banking tells you that large-scale corporate clients are in a very aggressive posture. They are borrowing heavy capital, engaging in wealth management, and executing really complex institutional transactions.
Right, but meanwhile, the contraction on the consumer and payment side tells a very different story about the everyday retail customer.
Exactly.
Because if consumer banking is down 4.4% and payments are dropping, that implies Main Street is really feeling the friction of the current macro environment. Retail customers might be pulling back on transaction volumes or, maintaining lower average balances, or maybe the bank is simply having to spend more money just to service and maintain those consumer accounts.
Which creates a serious strategic dilemma for management.
Right.
If your consumer business is a reliable but currently shrinking piece of the pie, you cannot just sit back and let it drag down your overall profitability. You have to find a way to plug that leak with new revenue streams that are, well, disconnected from the traditional consumer checking account.
And that transition brings us perfectly to how U.S. Bancorp is actively solving that dilemma. They are leaning heavily into capital markets on the institutional side and highly integrated tech on the consumer side to generate just massive streams of fee revenue.
Yeah, they really are.
Let's look at the BTI acquisition first, because this feels like a major pivot for a company traditionally known as just a regional bank.
Definitely. So the acquisition of Condor Trading LP, which operates as BTI, officially closed on June 1st, 2026.
Just a few weeks ago.
Right. And this is a very targeted play to supercharge that already booming corporate segment.
The immediate financial impact in the sources is wild, by the way. In just the single month since the acquisition closed, BTI generated $98 million in fee revenue against $84 million of non-interest expense.
Incredible turnaround.
Yeah, they essentially bolted on a highly profitable, self-contained engine overnight. And for context, BTI ranks among the top 10 U.S. brokers for high-touch equity trading volume, and they've executed over 150 investment banking transactions over the last decade.
It is so important to understand the mechanism of what they actually bought here, though.
Right, this isn't just an app.
No, high-touch equity trading isn't about retail investors buying 10 shares of stock on their phones. This involves massive institutional block trades like pension funds or asset managers moving millions of shares. Yeah, so it requires human expertise, deep liquidity networks, and highly specialized execution to avoid moving the market price against the client.
Oh, that makes sense.
Yeah, so by acquiring BTI, U.S. Bancorp can now offer its massive roster of commercial clients direct access to premier equity trading and investment banking services, which keeps those lucrative fees in-house rather than losing them to the legacy Wall Street banks.
So they are locking down the institutional side with high-touch brokerage services. But the strategy gets even more interesting when you look at how they're attacking the consumer and payments side.
Right, the technology play.
Exactly.
Yeah.
We need to talk about Elevon, their wholly owned subsidiary, which just rolled out an expansion of its all-in-one payments platform across North America.
Yeah.
And this is an Android-based point-of-sale system specifically designed for sectors like retail, healthcare, and hospitality.
Yeah, this is where the bank begins to look and operate a lot like a modern software company.
Really?
Yeah, because historically, a regional bank's relationship with, say, a local restaurant was mostly passive. The bank held the deposit account, maybe provided a business loan, and processed standard credit card badges at the end of the day.
But with this all-in-one Android system, they aren't just the vault where the restaurant stores its cash at the end of the night.
Nope.
They are providing the actual hardware and software the business uses to take orders, manage inventory, and process every single transaction.
And the underlying strategy here is all about creating insurmountable switching costs.
Oh, I see where this is going.
Yeah, if you're a restaurant owner and U.S. Bancorp just holds your checking account, you can move your money to a competitor tomorrow with very little headache.
Just wire the funds and close it.
Exactly. But if Elevon is running your physical cash registers, managing your employee logins, and handling your daily transaction flow, moving to a new bank means ripping out your entire operational infrastructure.
That completely transforms the bank from a passive vault into an active toll booth. I mean, they are embedding themselves at the physical point of sale, ensuring they get a cut of every single card swipe right at the cash register.
And that toll booth mechanism generates highly predictable, sticky, recurring revenue. The merchant gets a streamlined, cloud-connected business tool, and U.S. Bancorp secures a daily stream of transaction fees that are much less sensitive to interest rate fluctuations than traditional loans.
So what does this all mean when we look at the big picture? If you check the income statement, their non-interest income, which is the bucket for all this fee revenue, shot up 13.2% year over year.
That's a massive jump for non-interest income.
It is. Between acquiring a major institutional broker in BTI and scaling up a software-as-a-service payment platform in Elevon, they're aggressively diversifying.
Yeah, they are executing a classic revenue diversification playbook. Pure spread-based banking, where your entire business relies on earning the difference between the interest you pay on deposits and the interest you charge on loans, is incredibly risky in an unpredictable economy.
Because you're just totally exposed to the Fed.
Exactly. It leaves a bank entirely at the mercy of the Federal Reserve and the yield curve. By generating massive fee revenue through M&A advisory, equity trading, and merchant payment software, they insulate their earnings from interest rate volatility.
But, you cannot close the book on a financial deep dive without checking the risk radar. We've established they are growing loans at 7.1% and expanding aggressively into new markets. With all that rapid growth, how is their actual credit quality holding up?
That's the big question.
Right. If they are lending more, are they taking on riskier debt?
Well, if you look strictly at the present-day metrics, the credit quality is actually holding up exceptionally well. The net charge-off ratio actually improved down to 0.53% compared to 0.56% in the first quarter of the year.
And just to clarify for anyone unfamiliar, the net charge-off ratio represents the percentage of total loans that the bank has officially recognized as uncollectible and written off as a loss.
Right.
So seeing that number drop means fewer borrowers are currently defaulting. But the metric that really matters for the future is the provision for credit losses.
Yes, the forward-looking metric.
This is the pool of capital the bank intentionally sets aside to cover potential future bad loans. And that provision currently sits at $538 million.
And the mechanics of that $538 million figure are incredibly revealing. The report notes that the provision is higher on a year-over-year basis, but management makes it very clear that this increase is driven purely by the sheer math of their loan volume growth, not by a deterioration in borrower quality.
Ah, okay.
Yeah, if your total loan portfolio grows by 7.1%, your reserve pool has to grow proportionally, even if every single borrower is perfectly healthy.
Right, but here's where it gets really interesting, and frankly, a bit contradictory.
Oh, yeah.
Sequentially, from Q1 to Q2, the actual provision for credit losses dropped by 6.6%.
Yeah.
And the earnings report explicitly attributes this sequential drop to, quote, stabilizing economic conditions and improving credit quality. Yet, in the CEO's forward guidance, management explicitly warned investors that they are continuing to monitor severe economic uncertainty. They specifically flagged interest rate volatility, inflationary pressures, and evolving geopolitical events that could negatively affect the financial strength of their corporate and consumer borrowers.
It's quite the contrast.
Right. How do you reconcile a bank mathematically reducing its loss reserves because of a, stabilizing economy while simultaneously warning investors about inflation and geopolitical risk?
You reconcile it by understanding the friction between rigid accounting models and executive intuition.
Okay, tell me more about that.
So banks operate under a specific accounting standard known as Current Expected Credit Losses, or CECL. And these models are heavily quantitative. They ingest real-time macroeconomic data, things like current employment rates, GDP growth, and present default rates.
Got it.
So because the immediate backward-looking data shows that charge-offs dropped to 0.53% and current borrower health is stable, the math literally dictates that the required provision drops by 6.6%.
So their hands are tied by the numbers.
Exactly. The accounting models force an optimistic posture based on present reality.
But the management team isn't run by an algorithm.
What?
I mean, they have to manage a $405 billion loan portfolio in the real world.
That is exactly the point. Executive leadership has to serve as the voice of reason against their own accounting models.
Right.
The CEO knows that present stability does not guarantee future safety. They have to comply with the CECL math and report the lower provision today, but they are using the narrative guidance to establish a defensive posture.
To manage expectations.
Exactly. They are telegraphing to the market that while the spreadsheet looks great this quarter, they're fully aware that sticky inflation or some unexpected geopolitical shock could instantly change the credit dynamics of both their corporate and retail borrowers.
It is a massive operational tightrope, balancing the required optimism of quarterly accounting with the necessary paranoia of long-term risk management.
It really is.
But looking at the entirety of these sources, the final Q2 numbers show U.S. Bancorp is walking that tightrope highly effectively. I mean, they leveraged disciplined expense management, massive institutional growth, and strategic tech integration to deliver record revenues and a 22% pop in earnings per share, all while navigating a softening consumer segment.
The execution detailed in this report really highlights a fundamental evolution in how major financial institutions operate today.
Yeah.
The banks that are generating this level of outsized return, they're no longer just gathering local deposits and issuing local mortgages. They are building these highly interconnected financial ecosystems that are designed to capture revenue at every possible touch point.
Which leaves us with a final provocative thought for you to ponder based on this deep dive. Given the immediate high-margin impact of the BTI brokerage acquisition on the institutional side, and then the aggressive software-as-a-service expansion of the Elevon platform on the retail side, is U.S. Bancorp quietly attempting to shed its traditional identity as a straightforward regional bank in order to become a true hybrid investment bank fintech player?
It certainly looks that way.
It's a structural transition that every investor should be watching closely as we move into the second half of the year. Make sure you follow the show for daily, concise earnings coverage just like this. We will see you on the next deep dive.